about a year and a half ago, we were looking at taking over a restaurant space. It had been a successful restaurant for quite some time, owned by another group in town, and they had just kind of run its course. They wanted out of the business, so we were looking at taking it over. And the landlord really wanted us to be in that space. He liked our reputation. He liked me personally. And we had gotten relatively deep into the lease negotiations. And he had also agreed, in addition to giving us a favorable lease and giving us right of first refusal when this restaurant went out of business, he had offered to help us round up investors because I had explained to him that we already had another project on the front burner, and I was not going to redirect capital resources to the new project that he was proposing because he really wanted us as tenants in this space. And so during one of the discussions that I was having with him, we talked through the initial operating budget that I had come up with. We talked through the pre-opening costs that I was projecting. We talked through the revenue that I was projecting in the NOI after 5 years on the pro forma. And he said, "What's the IRR?" And I completely froze because I did not know what IRR meant. And he's a pro, he's a real estate magnate, and he played it cool and said initial rate of return. And I said, "Thank you very much. I will get back to you on that." And played it off as best I could, but I was embarrassed. And the goal of today's episode is to keep you from getting into situations like I got into. There have been many times meeting with real estate brokers or bankers or construction workers or hoteliers there that they used a term or an abbreviation or an acronym that I was unfamiliar with, and I just nodded and went and looked it up later because I didn't want them to know that I didn't have any idea what in the world they were talking about. This is the Restaurant Incubator. My name is Brandon Sharp. I'm your host. As an executive chef, I earned 7 straight Michelin stars. As an entrepreneur, I own and operate 3 restaurants in Chapel Hill. Experience is a cruel teacher. She gives you the tests first and the lessons later. I created the Restaurant Incubator so that when you are tested by the restaurant industry, you'll have heard the lessons and you will know the answers. The answers that I'm going to give you today are in the form of reference material for you. So I'm going to explain all of the abbreviations, acronyms, and initials that you need to know for your business career, your commercial real estate negotiations, and just some basic restaurant stuff as well in case you are unfamiliar with it. So I've been threatening to make this episode for a little while, and here it is. We will dive right into commercial real estate terms, and if you see the abbreviation CRE, that just stands for commercial real estate. LOI. LOI is your letter of intent. So this is the basic agreement, usually only a page or 2 long, that outlines the basic terms of a lease that you are interested in. So when you're interested in a restaurant space, your real estate broker and the other side's real estate broker, or just you and the landlord, if you are not dealing with brokers, will draw up an LOI. Either side can do this and say, these are the terms, this is the size of the space, this is the base rent that we expect to pay, these are the escalations year over year, this is the term, this is the address, just the basics like that. And you can add as much or as little stuff as you want to in there, but this gives you a format to agree on, and this should give you, as the prospective tenant, exclusive right to rent that space until the LOI expires. There's usually a 30, 60, or 90-day expiration date to the LOI. The longer the expiration date, the more it is in your favor. The shorter the expiration date, the more it is in the landlord's favor because the negotiation period will be shorter and you'll have less time to get your ducks in a row, talk to your lawyers, and get the lease terms settled the way that you want them. CAM, C-A-M, is common area maintenance. So this is a portion, this is usually appended to your rent in a monthly basis. So this is a fee that you pay your landlord. Let's say you rent part of your restaurant is in a larger complex. The entire complex is 10,000 square feet. Your restaurant is 2,000 square feet. That means your share of the common area maintenance charges is going to be 20%. So whatever the landscapers and other workers who, whatever upkeep the tenant does, let's say the landlord, he's got to get the lines in the parking lot painted once every 5 years. He's got to replace the bulbs in the street lamps. So all of those little things that he has to pay for are going to be doled out to you on a percentage basis in the form of CAM, common area maintenance. NNN, triple net. This is triple net lease. So this is a type of lease. This is the most common type of lease. This means that in addition to the base rent, you are going to pay taxes, insurance, and the maintenance. TI is tenant improvements. So tenant improvements is a very important number that you want to look for. This is the amount of money that the landlord is going to reimburse you for upgrades that you made to his space or her space. So the thinking on this is, one, you're probably going to have to pay it back over a slow amount of time, whether you realize it or not. It'll be built into the cost of your lease. This will be built into your per square foot rent, but it won't show up there. It'll just know that you will be paying it back. But this gives you some immediate capital relief. Let's say you spent $200,000 to open your restaurant. Let's say your construction charges were $150,000. Once you show the landlord, you get to opening day, you have your certificate of occupancy, you open the doors to paying customers, you show him all the receipts from your contractors and subcontractors to show that they have been paid, and you show the lien waivers that all the subcontractors and contractors are going to need to sign lien waivers for you, and you'll need to show those to the landlord because otherwise they could put a lien on the if they haven't been paid, they can actually have cause against the landlord to sue him. So the landlord is going to want to see the lien waivers before he pays out any tenant reimbursement, any tenant improvement dollars to you. And that's usually either a flat fee or it can be a amount of dollars per square foot that he's willing to pay you in return for upgrading his space, because a lot of the times the construction that he is paying, that he is reimbursing you for, is stuff that adds value to his property. He wouldn't have done it otherwise, but it adds value to his property because you can't take the plumbing with you when you go. NOI stands for net operating income. This is a fancy word for fancy term for profit. Net operating income is net profit. IRR, I mentioned earlier, this is the initial rate of return. This is what you can expect to return to your investors in year one. This is your NOI after year one, is your IRR. SF2, that's square footage. All right, so let's go into some business and financial terms. P&L is your profit and loss statement. This is your main financial statement. There are two. There's the profit and loss statement, and then there's the balance sheet. But the P&L, the profit and loss statement, starts off with your revenue, and then it lists all your expenses. This can be over a daily. This can be over 1 day, 1 month, 1 year. But this is what your tax returns will be based on. Will be based on your P&L over the year. And it's basically, the formula is revenue minus expenses equals NOI. And so those expenses will be delineated, but they are, cost of goods sold. The three main areas of expenses are cost of goods sold. So this is your wine, beer, liquor, and food costs all grouped together. Your cost of labor, so salaries and wages plus any contract labor plus any benefits, and then other expenses. So that is rent, that is linen, that's job supplies, that's software services, and all sorts of stuff like that. ROI, this is return on investment. So let's say you have had a great 5 years, but your restaurant is at capacity. You could do more volume, but you just don't have enough seats for it. So let's say you want to expand and you want to spend $30,000 building out the patio and gaining 30 seats that way. Well, okay, then you need to go to your investors and say, we're going to spend $30,000. One of them is going to say, okay, great. What's the ROI? And so the return on investment is, one, how long will it take you to pay back those $30,000? Two, how much will those extra seats and that $30,000 investment add to the revenue after year one? Three, how much profit will that $30,000 and those extra seats add to your NOI, your profit line, after year one? So those are different ways to calculate the ROI, which stands for return on investment. EBITDA or EBITDA, sometimes it's pronounced a couple of different ways, but this stands for your earnings before interest, taxes, depreciation, and amortization. So this measures your operating profitability. It doesn't measure your net operating income. So EBITDA is not the money that you put in the bank, but it really shows the financial health of your operations. COGS is cost of goods sold. This is applied to things that you sell, and what you sell are wine, beer, liquor, and food. Some of you sell retail and merch. Some of you sell CPG, which stands for consumer packaged goods. KPI is a key performance indicator. You may not be looking at KPIs if you are in a small restaurant or a small company. Once you get into hotels and restaurant chains, they will be looking at KPIs. Some common KPIs are for hotels, occupancy rate, and average room rate. And then for bigger restaurant chains, they'll be looking very closely at tracking PPA, which is per person average, or check average, and things like that. So those are some KPIs. So KPIs are statistics that you or your owner or your bookkeeper or your accountant find important, that they think are worth measuring. AR and AP stands for accounts receivable and accounts payable. Accounts receivable at small single unit restaurants and most restaurants is really nothing, because your accounts receivable, your customers pay when they eat, right? So your accounts receivable is really just your servers, bartenders, and POS system. Accounts payable might be you if you were the one writing the checks to your vendors. It might be a third party if you have a bookkeeper. It might be your accountant if you have an in-house accountant or director of finance. B2B and B2C, this stands for business to business or business to customer. So, for example, Cisco, any wholesalers or any broadline distributors are B2B, right? Because that's one business selling to another. If you are a restaurateur, you are B2C, you are a business selling to a customer. SOP stands for Standard Operating Procedure, and these are the systems and processes and policies you have in place for everything, whether it is how to open a bottle of wine to how to take reservations for Mother's Day. A few restaurant business terms that you probably know, but I will go over anyway. FOH is front of house. This is your customer-facing areas and staff, hosts, servers, bartenders, back waiters. BOH is back of house. This is for your kitchen workers and stewards, those who do not come in contact with the guests. POS stands for point of sale system. So this is your Square, your Toast, your cash register, anything that you use to process the transactions. PPA, I touched on this earlier. That is per person average. I call it check average, but PPA is a little bit clearer because that means per person. Some restaurants, when they say check average, that blends all checks, whether it's a solo diner at the bar or whether it's a party of 12, and gives you an overall check average. So PPA is a much more precise way to say that. FIFO stands for first in, first out. This is how you ought to manage your inventory. The oldest thing is what you should be serving, selling, or pulling from the stock room first. 86th. So 86, there are a lot of legends about how the term 86 came up, but 86 means that something is sold out or unavailable. It can also apply to a drunken, unruly, or problem guest who is banned from your restaurant. The most convincing legend that I have heard about the term 86 comes from the Old West. It was liquor was served at a very high proof, and when someone got too unruly and too drunk, they knocked them down to 86 proof alcohol, which is still packs quite a wallop. MOD stands for manager on duty. I'm going to throw, so this can be, so you may have a general manager, a floor manager, a dining room manager, a bar manager, but if one of them is in charge at the end of the night, that person is the MOD. If one of them is in charge before the place opens, that person is the opening MOD. I'm going to throw a double black diamond hotel set of initials here, PBX. So PBX is your internal operator. So that's the person in the hotel who is redirecting calls from one department to another, or from the lobby or the front desk to a certain room. PBX stands for Private Branch Exchange. I'm very proud to know that one. QSR is quick service restaurant. So these are fast food and counter service establishments. FSR is a full service restaurant. Sit down, table service, servers, bartenders, waitresses, all that stuff. BEO stands for Banquet Event Order. So this is the set of details. This should be a one-page document that has everything for an upcoming special event. That it should have the date, it should have the salesperson, it should have the time of day. It should have the meal period, so 11:30 brunch. It should have the size of the group coming. It should have the menu. It should have any special guests. It should have the contact person, and all of those details on there. So the BEO and the BEO can also be the contract that the guest has signed, but it will have the menu and all the details. It will have the head count and things like that on it. So BEO stands for Banquet Event Order. HACCP, HACCP, stands for Hazard Analysis Critical Control Point. So this is part of a food safety management system. A HACCP is a point in the flow of food from the delivery truck to the guest. So as soon as it comes in the back door, for certain food processes, for certain processing techniques, and in certain states, you'll be asked to do a HACCP analysis of a certain item that you were serving. Maybe it's smoked salmon, because that has curing, that has low temperature smoking, so it has some specialized techniques to it. And so a HACCP, a critical control point for the smoked salmon process, might be the curing and making sure that it is fully cured and making sure that it is at the right pH. So those are things that you may be asked to identify as an operator if you are using some specialized techniques like fermentation or smoking or curing and things like that. R&D stands for research and development. F&B stands for food and beverage. If you are getting value out of today's episode, please pause it, go up to that banner at the top, hit the drop down, click and give us 5 stars. That really helps the show. Okay, now a few essential marketing and sales terms. LTV, this is the lifetime value. This is the projected total revenue that you can expect from one customer over the entire relationship. So I think that it is underrated by most restaurants how important return business is. Churn is something that we don't talk about very often in the restaurant industry. I think churn can be fatal for independent restaurants because this means that you have somebody who comes in, they don't have a great time, they churn out, and they never come back. This is not a huge problem for online businesses, right? Because you can shop, people all over the world can shop at an online business, but for an anchored business like a restaurant, churn is very important, lifetime value is very important, therefore maintaining repeat customers and return guests is very, very important. CAC or CAC is the customer acquisition cost. This is how much it costs you to get someone in the door. CTR is your click-through rate. This is the percentage of users who click on a link or an ad after seeing it. CPC is cost per click. So sometimes if you are using some types of online advertising, maybe it's Yelp ads or Google ads or TripAdvisor ads, they may charge you on a cost per click basis. So this means maybe it's 45 cents that they're going to charge you every time somebody clicks on your ad. And believe me, that can add up quick. CPM stands for cost per 1,000 impressions, and the M comes from the French word mille, which means 1,000. So CPM is the cost to you of showing an ad 1,000 times. SEO stands for search engine optimization. This means making your website as full of as many keywords and as much good content as possible so that it is easy for search engines to find you, or for search engines to help people who are looking for fine dining or celebration dinner or non-alcoholic cocktails to find you on their web browser. CTA is a call to action. So this is a specific type of ad or message to your guests or social media posts in which you are making a specific call to action. So you're saying buy now or Black Friday deal, or it's a very specific thing. And my advice to you is, if you are don't put CTAs up all the time. Like all your Instagram posts or Facebook or whatever should not all be CTAs. Give people some valuable content and then make an ask, then make a CTA. Don't only post when you have CTAs. Post all the time. Post valuable content. Post entertaining content, and then make a CTA now and then. A/B testing, also known as split testing. So this is where you compose 2 different versions of an advertisement and measure the results and see which one did better. If B did better, then convert all of your advertising to B. Vice versa if A did better. The last 2 that I'll touch on are CPG. I mentioned that before. That is consumer packaged goods. And the last one is DTC, which is direct to consumer. So if you are doing CPG and you are selling it in your local grocery market, that is not direct to consumer. That is a B2B sale that you are making. If you're going DTC, that's direct to consumer. So that is somebody going on your website and buying the spaghetti sauce that you made and are having packaged in a licensed facility, but you are selling it direct to consumer on your website and you are probably shipping it to them. So that is a list of many and most of the abbreviations that you will need to know as you begin your entrepreneurial journey and start talking to bankers, lenders, landlords, and real estate brokers. If you're getting pretty far down the path towards getting serious about opening a restaurant, I created the Restaurant Launchpad. Maybe there's something there you can use. Click the link in the show notes. If you get to the point where you want even more help, you want my personal expertise, advice, input, and labor with those documents, with those programs, the Restaurant Accelerator is also available. Also, the link is in the show notes. Good luck out there, y'all. Stay humble, stay hungry.